For the majority of Australians, managed superannuation accounts represent their largest investment in the equity market and play a large role in determining their quality of life after retirement. It is therefore crucial that super investors ensure their investments are sensibly managed with respect to not only performance, but also tax effectiveness. Because superannuation for most people is a long-term investment, the ability of active fund managers to add marginal value potentially makes a very big difference at retirement. For example, if we invest $100 into the Australian equity market index today and it continues growing at the rate it has been for the last 2 decades, we should have around $580 in 20 years' time. On the other hand, if we invest the same money into a fund manager who outperforms the index by just 0.5% per year, we would end up with almost $50 more. By investing our super with an active equity fund, we are betting on the fund manager being able to generate returns that exceed the market return after covering their costs of trading and fees. Our results show that at least before fees, active fund managers on average seem to be able to outperform the index. Over the period in which we studied the funds in our sample, the fund managers generated pre-tax returns of 0.2% per annum above the market. Going back to our $100 investment, we would end up with roughly $600 in 20 years' time. What's really surprising, however, is that when we compared portfolios that are rebalanced daily to those that are rebalanced every 3 months, the portfolios that are rebalanced daily did better by 0.7% per year, even taking into account the higher costs associated with the portfolio that is rebalanced more frequently. That means that a huge part of the value proposition fund managers bring to investors is their ability to time their trades within year quarters. Because of the way the Australian tax system is structured, superannuation investors actually get a net boost from tax effects. This is because fully franked dividends receive imputation credits worth an additional 43% of the value of the dividend itself, and most companies pay fully franked dividends. After taking away income tax and CGT, the remaining credits add an additional 0.35% to post-tax returns. In a hypothetical world where funds don't charge fees and past returns are indicative of future returns, our $100 investment would turn into almost $640 after 20 years. However, it turns out that the style of fund manager we pick to manage our money also matters. If we had picked only funds with a value style, our portfolio would have been $660 before fees but after taxes after 20 years. Picking funds with a growth style would have earned us even more, $680 after 20 years. Surprisingly, we find that value funds generate much more of their value through their ability to time their trades than other fund styles. Lastly, if we had picked funds with no strong tilt towards either growth or value, we would have actually underperformed by 0.3% a year relative to the market and earned only $550. In Australia, active fund managers on average do provide marginal after-tax returns to investors before fees. Insofar as the investment skill of these managers can be accessed at a reasonable price, superannuation investors can find superior returns relative to the index through active Australian equity funds with strong style tilts.